Welcome back to the Pro Ticker Podcast, your Thursday morning edition, covering major financial magazine headlines, everyone.
Good morning. Although, looking at the heat maps on the trading terminals this week, morning might be the only positive thing we can say. It is pretty ugly out there.
Ugly is putting it mildly. I think if you open your brokerage app in the last 48 hours, the visceral reaction was probably to just close it immediately and go find a very stiff drink. It's a sea of red ink across the board. But what strikes me isn't just that people are selling, markets go down, that happens. It's what is being sold. We're looking at a stack of reports today from Reuters, Bloomberg, CNBC, and Yahoo Finance, and they're all painting this picture of a market that seems to be having a nervous breakdown about the future.
Nervous breakdown is a colorful way to put it. I think reckoning is probably the financial term we're looking for. We aren't just seeing a bad trading week, we're seeing a fundamental crisis of faith. That is the theme that just jumps out at me from all these sources.
A crisis of faith.
Yeah, think about it. For 2 years, the market had a very specific, almost an easy playbook. Buy AI because it changes the world, buy crypto because it's the future of money, and buy growth stocks because, rates will eventually come down.
Right.
Now, investors are looking at those exact same assets and asking, wait, is this actually worth what I paid for it?
And that is our mission for this deep dive. We need to parse whether this is just a temporary panic, a classic buy the dip moment, or if the fundamental rules of the game have actually shifted under our feet.
I think they have.
Because when you see headlines in our source stack like Software-mageddon and Bitcoin death spiral, you can't just ignore that as noise.
Absolutely not. That buy the dip muscle memory that traders have built up since 2020 is being tested like never before. And, well, the data suggests the dip just keeps on dipping.
Okay, so let's start with that term that jumped out from the Reuters report, Software-mageddon. It sounds like a bad summer blockbuster, but for investors in companies like Salesforce, Intuit, or Service, now, the losses are incredibly real. These stocks are getting hammered.
It is a dramatic term, but it really captures the psychological shift perfectly. You have to understand the context here. For the last decade, the investment thesis for software, specifically SaaS, or software as a service, was the closest thing to a free lunch on Wall Street.
A money printing machine.
Exactly. You get a customer to subscribe, they pay you forever, sticking rates are high, you have huge profit margins. But Reuters is pointing out that the market is suddenly terrified that the AI party is actually a funeral for this business model.
Right, because up until, maybe 3 months ago, the whole narrative was AI helps software.
Correct.
If you're Salesforce, you add an AI chatbot, you charge 10% more, and your stock goes up. That was the logic.
Exactly. That was the AI as a tool phase. It was additive. But what we're entering now, according to the analysis in Reuters, is the AI as a competitor phase. The fear isn't that these companies won't use AI. The fear is that we won't need their software at all because an AI agent can do the job cheaper and faster and without the clunky interface.
The Reuters report specifically flags Anthropic's Claude model here as a catalyst for this fear.
Right. And this is where it gets a little technical, but it's crucial. Tools like Claude or the new OpenAI models are getting so good at agentic workflows, doing tasks from start to finish, that investors are asking these really difficult questions.
Like what?
For example, why do I need a complex, expensive, seat-based subscription for accounting software if a large language model can just ingest my spreadsheets, understand the tax code, and do my filing for a fraction of the cost?
So the moat is drying up.
The moat is being filled with concrete. That's the AI paradox. The better the AI gets, the more it threatens the legacy software pricing models that Wall Street loves. And the market is punishing that risk ruthlessly.
You mentioned Intuit and ServiceNow. These were quality companies, market darlings.
They were. And now Reuters notes they are among the biggest decliners of the year.
And it's not just the specialized players. Even the mothership took a hit. Microsoft, which is usually the bedrock, the safety play of any tech portfolio, had a disappointing earnings report.
Yeah.
And when Microsoft sneezes, the whole sector catches a cold.
Microsoft is the bellwether. But I think the Microsoft news actually bleeds into the second and perhaps financially scarier part of this tech wreck. It's not just about revenue risk, it's about the cost of doing business. We have to talk about the Capex scare.
Okay, this was the jaw dropper in the CNBC report about Alphabet, Google's parent company. The numbers are they're astronomical.
They are.
CNBC is reporting that investors are totally spooked by reports that Alphabet could more than double its capital expenditures, its CapEx, in 2026.
And let's just unpack CapEx for a second, because it sounds like this boring accountant speak, but it's actually the most important metric in tech right now. CapEx is hard cash spent on physical infrastructure.
Building data centers.
Pouring concrete, buying rack after rack of NVIDIA chips, cooling systems. Doubling that spend is an insane amount of money. We are talking about spending the GDP of a small country just to stay relevant in the AI game.
And usually, investors love investment in growth. You know, if you're building a factory to sell more cars, that's a good thing. But CNBC says the reaction this time was just overwhelmingly negative. Why the switch?
Margin compression. It's that simple. Wall Street loves profits today. If you take $50 billion and spend it on chips, that is $50 billion, that isn't going to profit margins, it isn't going to dividends, and it isn't going to share buybacks.
It's a classic catch-22.
It is. Think about being the CEO of Google right now. If you don't spend the money, you lose the AI race to OpenAI or Microsoft, and your company becomes obsolete.
But if you do spend the money,
you wreck your balance sheet for the next 2 years, and shareholders revolt.
So they're damned if they do, damned if they don't.
Precisely. And Wall Street is just in a show me the money mood. They're tired of hearing, AI will change the world in 2030. They want to know, how does this justify doubling your spending in 2026? The patience has run out.
That impatience really explains the absolute bloodbath at AMD. CNBC called it a brutal day for them on Wednesday. The stock plummeted 17%.
Yeah.
In a single session.
17% for a company the size of AMD is a catastrophe. That is billions in market cap vaporized. And again, look at the reason. Concerns over operating expenses.
It costs a fortune.
A fortune to design these chips to compete with NVIDIA. The market is looking at AMD and saying, you are spending too much to chase a market where you are arguably a distant second place.
I saw a note in that CNBC report from Jim Cramer. Now, he's usually the cheerleader, always finding a bull case. But even he was telling investors to remember diversification. He said, quote, tech stocks aren't worth as much as we thought.
And that is a telling moment. When the cheerleaders turn cautious, you know the sentiment has fundamentally shifted. It's a re-rating. The market is realizing that growth at any cost is over. We are back to growth at a reasonable price. And right now, with these CapEx numbers, AI is not looking like a reasonable price.
So we have a crisis of faith in software value and hardware costs. But if you thought the equity markets were rough, we have to look at the crypto markets. Because rough doesn't even cover it. Implosion feels more accurate.
This is a total washout, a complete invalidation of the recent trend.
Bloomberg is reporting Bitcoin has slumped below $72,000. Now, for the uninitiated, that might still sound like a lot of money compared to 5 years ago.
Right.
But that is the lowest level since the Trump election win back in November 2024. It erased the entire post-election rally.
The context is key here. Bitcoin is down 42% from its peak in October. That is nearly half its value gone in just a few months. In traditional finance, a 20% drop is a bear market. This is a crash.
And unlike the tech stocks, where we can point to earnings reports or CapEx spending as the culprit, this crash seems to have a very specific political trigger. Yahoo Finance highlighted a testimony from Treasury Secretary Scott Bessent. Why was this such a big deal?
It was the moment the music stopped. Secretary Bessent was testifying before the House Financial Services Committee. Usually these hearings are just political theater that markets ignore.
Okay.
But he was asked the one question that every crypto bull has been secretly banking on. If the crypto market collapses, will the Treasury backstop it? Will there be a bailout like we saw for banks in 2008?
And he didn't waffle, did he?
No. He was blunt. He said, quote, I do not have the authority. He explicitly stated that as chair of the FSOC, that's the Financial Stability Oversight Council, basically the government's risk police, he does not have the power to bail out crypto.
That seems like such a technicality. I don't have the authority, but the market took it as a death sentence.
Because it removed the Treasury put. A lot of institutional money flowed into crypto recently thinking it was becoming too big to fail. They assumed that because BlackRock and the ETFs were involved, the government would have to step in if things went south to protect the little guy. Bessent made it clear, you are on your own. This is a speculative asset class, and if it goes to zero, the Treasury isn't writing you a check.
And that reality check broke all the key support levels. But it's not just the government stepping back. We're seeing some legendary bears coming out of hibernation to twist the knife. Yahoo Finance picked up a warning from Michael Burry,
The Big Short guy himself.
the man who bet against the housing market in 2008. And he is not mincing words here. He called Bitcoin a purely speculative asset. And he explicitly said it is not a hedge like gold.
And that just cuts to the core of the Bitcoin thesis. The whole sales pitch for the last year has been digital gold, a store of value against inflation. Burry is saying, no, it's just a gambling chip.
Right.
And when the market is scared, nobody wants to be holding gambling chips.
He went even further. He warned of a death spiral leading to massive value destruction. A death spiral. That is terrifying language.
It describes a liquidity crisis. It's a mechanical failure of the market. As prices drop, people on leverage get margin called, so they strictly have to sell, which drops the price further, which causes more margin calls. It just becomes a self-fulfilling prophecy.
And when you have no government backstop.
And famous investors calling for a spiral, confidence just evaporates instantly.
It seems like that confidence is already gone. 10X Research put out a note saying there is no urgency to buy the dip.
That's the crisis of faith again. Usually when Bitcoin drops 40%, the laser eyes crowd is screaming on social media to buy. 10X Research is saying the broader downtrend is intact. One strategist, Shiliang Tang from Monarch Asset Management, put it perfectly in the Yahoo report. It's not about price anymore, it's about belief. And right now, investors just don't believe the narrative.
So the U.S. tech sector is in software-mageddon. Crypto is in a death spiral. Naturally, capital usually looks for a safe haven overseas. But if you're looking at China, the answer seems to be a resounding no.
Yeah, if you thought the U.S. was volatile, do not look at the Hang Seng.
CNBC is reporting that Hong Kong-listed tech stocks have officially entered a bear market. The Hang Seng Tech Index is down 20% from October. What's driving the sell-off there? Is it the same AI fears we see here?
It's a mix. There is the AI element, but the immediate trigger in China is an old foe. Regulation. There are strong rumors circulating about a value-added tax, or VAT, hike.
A tax on what specifically?
On internet services and online gaming. Now, China already hiked the VAT on telecom services, so the market is connecting the dots. They think Tencent, Alibaba, and the gaming giants are next.
And nothing kills a stock rally faster.
Nothing, not faster than the government taking a bigger slice of the top-line revenue.
It feels like just as those stocks were recovering, the regulatory shadow is back. But there was another detail in the sources, something about NVIDIA and OpenAI having a falling out.
This is the rumor that's shaking the hardware supply chain all across Asia. There's talk of a rupture between NVIDIA and OpenAI.
Wait, really? The biggest chip maker and the biggest AI company. That's like a celebrity breakup for the tech world.
It is huge if it's true. The rumor suggests OpenAI might be looking to reduce reliance on NVIDIA, or that their partnership is fraying. If that's the case, it creates massive uncertainty for the entire Asian supply chain, TSMC, Foxconn, SK Hynix, everyone who builds these components. It just adds another layer of risk-off sentiment.
So China is out. But looking at the CNBC report, there seems to be this fascinating counter-narrative emerging in India.
This is the most interesting divergence in the global market right now. You have two absolute titans, Larry Fink, CEO of BlackRock, and Mukesh Ambani, chairman of Reliance Industries, basically doing a joint sales pitch for the Indian economy.
I saw that. They're trying to get Indians to change how they save money.
It's a massive cultural shift they're pushing. Right now, Indians hold about 59% of their assets in gold and real estate. It's a very traditional way to hold wealth. Ambani actually called gold unproductive.
That's a polite way of saying it's a shiny rock that sits in a safe and does nothing.
Precisely. It doesn't generate yield, it doesn't build factories. Larry Fink is arguing that the stock market provides compounding. He called the next 25 years the era of India.
That is a bold call, especially when the rest of the world is panicking. Why push this now?
It tells you where the smart money wants to go. The West is panicking about capex returns. China is dealing with taxes and demographics. Global capital needs a growth story, and Fink is betting the house that India is the last growth story standing. He wants that domestic Indian capital to move from gold into equities to fuel that rise.
So we have chaos in the U.S. and China, and a desperate push for India. But we have to zoom out to the macro picture. Because all of this tech, crypto, global flows, it's all happening against the backdrop of the Federal Reserve. And there's a massive shift looming there that Yahoo Finance is covering.
This is the variable that could change the whole equation. The Fed sets the price of money, and the price of money dictates everything else.
Yahoo Finance has a deep profile on Kevin Warsh. He's President Trump's nominee for Federal Reserve Chair. Now, Warsh isn't a newbie. He's been around the block.
He has a long history. And if you look at his time at the Fed from 2006 to 2011, he was known as a hawk, a serious inflation hawk. He was the guy always voting against easy money, always worried about the dollar losing value.
So standard logic says hawk equals higher interest rates to kill inflation.
Traditionally, yes. If you hear hawk, you sell stocks. But Warsh is throwing a curveball. He is now advocating for lower interest rates.
A hawk who wants to cut rates. That sounds contradictory. How does he justify that pivot without looking inconsistent?
It all comes back to AI.
Of course it does.
Warsh has developed this theory that AI is a positive supply-side shock. He believes AI will boost productivity so much, making workers so efficient, that it will naturally crush inflation.
Let's break that down for the listener. If companies can make more widgets for less money because of robots and AI, prices go down.
Exactly, it's disinflationary. So Warsh's argument is, we don't need high interest rates to fight inflation because AI is going to fight inflation for us. Therefore, the Fed can cut rates and let the economy run hot without prices spiraling.
That is an incredibly optimistic view. He's basically betting the entire monetary policy of the U.S. on the success of the AI revolution. The same revolution that the stock market is currently panic selling because of high costs.
It's a high-stakes gamble. If he's right, we get a roaring 20s, boom low rates and high growth. If he's wrong, and AI takes 10 years to really work, he cuts rates and inflation explodes.
There's the political angle, too. Yahoo highlights his fierce independence.
Right. President Trump wants low rates. Warsh wants low rates. But Warsh insists he won't take orders from the president. It's going to be a delicate dance. If he gets confirmed, the market has to figure out, is he cutting rates because the president said so, or because he truly believes in the AI miracle?
Uncertainty on top of uncertainty.
That is the word of the week.
So let's look ahead. We're recording this on Thursday. Despite the software Mageddon, Yahoo Finance is reporting that U.S. stock futures actually edged up a bit this morning.
I wouldn't read too much into that yet. It could be a dead cat bounce, just a little reaction after a massive drop. Or maybe some bargain hunters are stepping in who think the selling is overdone.
But everyone is holding their breath for one specific event this afternoon.
Amazon.
Amazon is due to release earnings.
This is the tiebreaker. Microsoft disappointed the market. Alphabet scared everyone with spending. Now Amazon has to show their cards.
What are we looking for?
We need to see if their cloud division, AWS, is actually making money from all this AI spending. If Amazon says, we are spending billions and margins are shrinking, look out below. We could see another leg down in the market.
But if they show that the AI spending is actually generating cold, hard cash?
Then maybe it calms the nerves. The market is desperate for proof. We have been running on hype for 2 years. Now the bill is due.
So, summarizing this deep dive, we have a repricing of tech, a collapse in crypto confidence, regulatory fears in China, and a potential new Fed chair betting on an AI future that is currently in question.
It's the end of easy mode. You can't just throw a dart at a tech ticker anymore. You have to look at cash flow, profitability, and valuations.
Before we wrap up, I want to leave you with a thought. We talked about Michael Burry saying crypto isn't a hedge. We talked about Larry Fink saying gold is unproductive. And we talked about tech stocks crashing.
It raises the trillion-dollar question.
Exactly. If the digital safe haven is crashing and the physical safe haven is unproductive and the growth engine is stalling, where does the capital go?
Does it go to bonds? Does it go to cash? Or does it flow into emerging markets like India?
The map of safe havens is being redrawn right in front of our eyes. And I have a feeling we're going to be tracking that money flow very closely over the next few months.
It's going to be a fascinating year.
Well, we will be here to track it. That's all we have for today's deep dive into the market chaos. Hang in there, check your asset allocation, and maybe don't refresh your portfolio apps too many times today.
Good advice.
Thank you for listening, and we'll see you all tomorrow morning with new headlines from major financial magazines.